Okay, so that's done. Please send your email address and then it can be sent directly to you. So I think that's now settled. So I was talking of two questions. There's one, I'm not very sure I gave you this, but this one was going to help you with the first part we are done of partnership. We are talking about admission and retirement. The question we did December 2014, question one, you look inaitwa BD. BD Enterprises was for admission. Remember they were admitting a partner, the illustration we did. So I told you there is another side to it, and the other side to it is retirement. And now the retirement question, which you will confirm if I've given you, is December 2022. December 2022 is retirement. December 2022, question 3A. So did I give you that question? December 2022, question 3A. Mkona hiyo?
You gave us an assignment.
Niliwapatia. Sasa unaona na wananyamaza. Huyo ni nani? Hata wasemi. So I thought like it's really far-fetched. Kumbe hata mkona swali, you know? So did you try it? Nani alijaribu December 2022, question 3A? So there's that one, and there's conversion. Sasa hata sijui tufanye gani kwanza. I think tutafanya today, instead of introducing something new, let me just do questions for today. Tutaanza na December 2022. Why I'm starting with ama sijui kama tuta mix up notes, because this one is for retirement. Mnaonaje? Tufanye hii kwanza ama tufanye conversion kwanza, because we've just done notes za conversion. Tufanye conversion kwanza, eh? What do you suggest? Ama it doesn't matter to you? Which is more organized? Do I do December 2022? Unajua hiyo is on retirement, the earlier section, eh? Tufanye admission or retirement, then conversion. Tufanye conversion kwanza, because we have the notes ready. Ama, and then we do this one. What do you think? Hakuna mtu ana opinion? Wacha tufanye conversion kwanza. Tufanye November 2015, eh? So that your notes are orderly. To fix kwa segment ya notes zenu, and then probably we'll fit this one somewhere. In your retirement, a different aspect. So December 2022, if you, not December, November 2014, if you can turn there, November 2014, question 3. November 2014, I think is the whole of 2015. November 2015 is the whole part, A, B, and C. November 2015. So kama umepata, you can tell us what page. Mine could be different from yours, but mine is page 140. But it could be different from yours. Sijui yenu ni page gani? Mine is page 140. We are looking at November 2015 first. November 2015 is conversion of a partnership into a limited liability company. We had already discussed the notes for those probably who are joining the class for the first time. So we are looking at November 2015. This is question.
Page 108.
Page 1. Mine is 140. Yenyu sijui ni gani?
108.
108. Wanasema hii iko page 108. Yangu ni page 140. So it seems kwa wengine ni page 108. So if you can turn there. So we'll read through the question. Kama umepata, tasoma. So a company is being, partnership is being converted into a limited liability company. So we'd already done the discussion. So let's look at the illustration together. So the question reads, James and Katana established a partnership business, sharing profits and losses in the ratio of 3:2. That's okay. The following is the income statement of the partnership for the year ended 31st December. So sales is 67.28, unrealized foreign exchange gain, capital gain on sale of shares, recovery from insurance on stock stolen, goods transferred to a branch at cost, dividends from Kylie Cooperative Society, giving us total income of 79.45, less expenses, purchases, purchase of computers, partners' salaries, legal fees, repairs and maintenance, rent and rates, interest on loan, general expenses, motor vehicle expenses, insurance, preliminary expenses, director's fees, audit fees, debenture interest, traveling expenses, giving us a net loss of 883,200. Then you have additional information. The partnership was converted into a limited liability company by the name Kaka Limited on 1st October. Now that timing is very important. So we know January up to September, 9 months is the partnership. Then October, November, December, 3 months is the limited company called Kaka Limited. And then this Okay, sorry for that. So we were going to read the additional information. We've done additional information number 1. Number 2, purchases and sales were inclusive of VAT at the rate of 16%. 16%. Then 3, closing stock was valued at 1840,000, while opening stock was valued at 10% sales net of VAT. 4, legal fees comprise petition to Association of Manufacturers, notice for change of business name, conveyance fees of business premises, stamp duty, negotiating a business loan, recovery of bad debts, signing a 100-year lease agreement, purchase of partners' private residence gyms, appeal against tax arrears, repairs and maintenance comprise purchase of furniture, installation of neon sign, designing an office block, cost of partitioning office block, repainting of business premises. 6, general expenses included registering of patent rights, 64,000, flotation cost, 48,000, and negotiating cost for an additional piece of land for business expansion of 56,000. 8, interest on loan includes interest on partners' capital of 100,000, which was shared according to the profit and loss sharing ratio. So required a statement of adjusted taxable profit or loss for the business, for the year ended. Then the examiner gives us a hint. He says, start with gross profit. So we all know, I know you are experienced custom students, when he says hint, it means you must start from gross profit. And you notice we don't have gross profit. So it means we'll start with a working note, work out the gross profit first, and then you proceed. I'll explain how you're going to proceed. B, comment on the tax position of James, Katana, and the company. And C, citing examples, advise James and Katana on 2 areas of tax avoidance that they could explore for the business. So in questions of conversion, you are required to prepare a statement. Now, if you remember from our notes, we said we need a statement for the partnership, and we also need a statement for the business for the different periods of operation. Now, for ease, we simply prepare one statement, but column now. So the first column will be for the partnership, say J and K. It's J and K partnership, James and Katana. Then the second column will be Kaka Limited. In the meantime, we'll work out the gross profit. Then we'll do apportionment for the 2 periods. Why apportionment? Usually in questions like this, there must be a statement that tells you that revenues and expenses accrue equally for the year or accrue evenly. Now, that gives you a green light to do the apportionment. So all questions like this, even the first question we did, I think there was an apportionment, but the apportionment we did that apportionment in the distribution. When we were distributing is when we like add every item for the different periods, before admission and after. Okay, so we'll start by preparing a statement, not very many statements, but just one statement. The division will be columns, a column for the company and a column for the business. So this is how it goes. So we'll title it statement of I'll just call it business profit, statement of business profit or loss for the year ended. December 2022. The first column will be J and K, that's the partnership. Partnership. And I think we can use thousands of units. Then the second column now this one is called CAC. So that's how it's going to work. But the first thing we look for is the gross profit, because we're given a hint. We were told we must use the gross profit. We must start from the gross profit. So we want to start from the gross profit. So let's get the gross profit. And we keep in mind note number 2. It says 2 and 3. It says purchases and sales were inclusive of VAT at the rate of 16%. So you know that under Section 16 of the Income Tax Act, taxes are not supposed to be included. So we'll find a way of adjusting for VAT. And note 3 also, closing stock was valued at 1840, while opening stock was valued at 10% of sales net of VAT. Okay, so we'll start by getting sales, which is inclusive of VAT. So if sales is inclusive of VAT, we will adjust by multiplying by 100 over 116, as we've always done. So we look for sales. Sales is 67.28. So 67.28 we multiply by 100 over 116. Now the result of that. So you can confirm this figure. So 67.28 we multiply by 100. We divide by 116 because it's inclusive of VAT is 5.8 million. Okay. Really? No. Then. Clinical class. Clinical class. Kuna takandi. Kuipi. Nani? Kuna takandi. Again, poleni sana. Poleni sana, it's an emergency. I have a colleague. He has a patient in hospital, ametumwa anunue dawa, and he needed a bit of my help. So I could not avoid it because I knew he needed some assistance. So singeweza ignore simu yake, it's an emergency. Okay, sales to adjust for VAT. We are trying to get the gross profit. So from our accounting, we're going to say less cost of sales. Cost of sales, we get opening stock. Now, opening stock, you'll get in note number, look at note number 3, additional information. It says closing stock was valued at 1,840, while opening stock was 10% of sales net of VAT. Sales net of VAT is this one, 5,800,000. So 10%, you can see, is 580. 10% of sales net of VAT is 580. So our opening stock is 580. Then our purchases figure is also inclusive of VAT, but you can pick purchases from the statement. Purchases wanasema ni 2842. Okay, so come here and say purchases. Utasema 2842 multiplied by 100 over 116. Kwa sababu gani? Kwa sababu ya VAT tena. So we have to adjust for VAT. So to adjust here. So we take 2842, we multiply by 100, we divide by 116, and we get net of, I hope you got this figure of 2450. Then we add this to, this is an accounting. I'm sure you can remember your accounting. It's 30, 30. But then you must lessen the closing stock. So closing stock. Closing stock tumepewa note yake. Note ya closing stock iko note number 3. Wanasema closing stock was valued at 1840. So unatoa hapa 1840. So the difference should give us the cost of goods sold. So 30 subtract 1840. The cost of goods sold is 1190. So the cost of sales is 1190. So you 1190 unatoa from gross profit, sales, and we get our gross profit. So the gross profit we were looking for, we can get that's when you get 4610. Okay, now so this is gross profit. So that's the gross profit the examiner was asking for, 4610. That's where we'll start our adjustment. The next thing is to establish timing, and you should be very careful. Ni kitu kidogo, but very, very important. Establish timing. Yani, tutakuwa tunafanya apportionment. We must know hii partnership ni ngapi, na company ni ngapi. It's very important. Be careful with these little things. So the partnership, J&K partnership, J&K partnership itakuwa ni miezi 9 mpaka September. So I can say apportionment yake is 8 months over 12. Sorry, 9 months. 9 months over 12. 9 months over 12, I can divide by 3. I think I'll get something like 3 quarters. If I'm not wrong here, I divide everything by 3, I get something like 3 quarters. I simplify. Then Kaka Limited. So Kaka Limited is the company. The company is now October, November, December is 3 months. So the company is 3 months over 12 will become a quarter. So once that is established, I'll tell you why this is important. Everything is assumed to have accrued evenly or equally. So for example, I'll get a quarter of 4610, 1 quarter, and that will be for the company. I put on the company column, then I simply multiply by 3. So that's how it will work out. Now we can go back to our statement and start from the gross profit as recommended by the examiner. So start from the gross profit as stated by the examiner. So we are there now in the statement. We want to start from the gross profit. So we'll say gross profit. Gross profit. So this gross profit is from note number 1. So we'll take the 4610. We were told that it accrued evenly. So I'll divide it by 4 for the 3 months, and I get 1152.5, and that will be for the company. 1152.5. Then I'll multiply by 3 quarters. So times 3, and times 3 is 3457. 3457.5. And we are done. So when now you start from the gross profit, there's something else you must do. You must get trading incomes. Trading incomes are incomes that are generated in the business that are not what you'd call other sources. So other sources are outside the business, like rent, farming income. I'm not talking about those. Business incomes will be things like discounts received, that's a business income, insurance compensation for stock, you know, probably in some questions we could even have bad debts recovered. Bad debts recovered if it was specific. Those are the kind of incomes I'm talking about. So going back to examine this statement, look for any other trading incomes that you can add to gross profit. And the trading incomes, you can look at the incomes listed after sales. There's unrealized foreign exchange gain. We cannot put that one because you remember from our first discussion, the gain has not yet been realized. So the accountant has put the gain simply because the exchange rate is favorable, but the transaction is not yet complete. So until it is realized, we cannot include it. So we leave that out. Capital gain on sale of shares is a different source. It's outside the business. They sold shares. So that's an income of a capital nature. Recovery from insurance on stock stolen, now that's a business income. So stock is part of trading activity or part of trading material, you know. So it was stolen and insurance has paid compensation. Actually, in the current finance bill, they even want to tax insurance compensation. like this one. So we come here and say insurance recovery. Insurance recovery. So this is for stock. So sometimes insurance recovery could be for a motor vehicle. That one will be capital. You cannot add that. It has to be for stock. So 480, I get 1/4 of 480, and it is 120. Then I multiply that by 3. That will be 120. I multiply by 3, I get 360. Then I continue looking. Probably I can get another income. Goods transferred to a branch at cost. So the cost of those goods is still part of trading income. So I'll add here goods transferred. Goods transferred to branch. Goods transferred to branch at cost 184. We do the same thing. I'll get 1/4 for the company. So 184, I'll get 1/4 is 46. 46. Then you can multiply that by 3, and you get 138. Okay. Then the other income is dividends from Kali Cooperative Society. Now, those are other specified sources. You don't mix with trading income. So having looked at every income, I simply get the totality of this. We add. So we'll add to get the total income of the business so far. So 3457.5, we add 360, and we add 138. And the result is 3955.5. This other one is 1152.5. We add, that's 166. And we get 18.5. So here it's called total income. Once we have total income, then we deduct allowable expenses. So it's say less allowable expenses. I need to explain something here before a question arises. Probably something is in your mind. You're wondering, when do you add back? Because the format we had done was for adding back. So the first question we did, we were adding back. So probably some of you are wondering, when do I add back? When do I deduct allowable expenses? It depends on where you start. If you start from the reported profit or loss, then you use the format we have done. You add back and you deduct. But in this question, we did not have a choice. The examiner says, don't start with the reported profit or reported loss. In that case, you cannot add back. He said, start from gross profit. So if you start from the gross profit, then it means everything is being calculated purely from tax point of view, not accounting. Unajua ukianza from reported profit, it means they had already deducted expenses based on accounting perspective. They had already included incomes based on accounting perspective. But if I start from gross profit is from the trading account. Once I get the gross profit from the trading account, I'm only adding incomes that are taxable here. So everything is purely from tax point of view. Then once I get the total income, then I only deduct what is allowable from tax point of view. So there are two different approaches. Nikianza na reported profit, I add back. Why am I adding back? Because to arrive at the reported profit, just like we discussed earlier, there are some things that have happened. They deducted expenses that are not allowed. So you add them back. You add back capital expenditure items and so on. This approach is different. You calculate gross profit, which is purely from the trading account. In the trading account, you look for other trading incomes to add the gross profit, like discounts received, insurance compensation for stock, not for motor vehicle. If you have things like foreign exchange gains, you add, if you have goods transferred to branch. Now, once you get the total income, then you only deduct what is allowed. That's why I put here less allowable expenses. So you'll go through the expenses in the income statement and we'll be picking. We'll not be taking everything. We'll only take out what is allowed. But if you have any other question, you can ask. I thought probably that is what could be ringing in your mind. Why are we still deducting? And in the other one, we were adding back. So I thought I should answer that. But even if you're not really clear about it, you can still ask me to rewind. There'll be no problem. No, I can still explain again. So at this point, we go to the expenses and we only pick what is allowed. So the first expense there is called purchases, but you must understand purchases was already included in the trading account. You remember the working that helped us to get the gross profit? We had used purchases there. So we cannot include again purchases in the trade. This is the P&L now. So purchases was already in the trading account to arrive at the gross profit. So you cannot include it in the profit and loss account. The next item is purchase of computers. Then again, I will suggest that computers is a capital expenditure. What we are supposed to deduct is investment allowances. But I will suggest to you that all investment allowances, just like in the other question, we do that as the last exercise. So we deduct all the other expenses, we leave out capital expenditure, and deduct all the allowances or investment allowances at the very end, all of them at once. So we leave out any capital expenditure and deal with it at the very end. So purchase of computers, we can hold on to that thought. Partner salaries, we know is not allowable. Why? We said any payments to partners under section 16, which we discussed, is considered as personal. Why were all payments to partners, including salary, interest on capital, drawing? Why do we call them personal? Just like in a sole proprietorship and in a partnership, the business does not exist in law. It is not recognized as a legal entity. So the business cannot pay the partners. So who has paid him? He has paid himself. Any expense you incur for your own maintenance, for maintenance of self, maintenance of family, or for purposes that are personal are not allowed. So this is a personal expense, partner salaries. So we don't put it because we're only putting allowable expenses. Then we go to legal expenses, and there's a note on legal expenses. So you can look at note number 4 for legal expenses. So we'll go through the liner where there's petition to Association of Manufacturers. Just like I told you, in the list of allowable expenses, you will not see this one. But I did mention that the list which we did, which we call section 15, is a guideline, is a set of principles. We can use that list now to decide on this. Now, what is in that list, if you've gone through it, is something called subscription. So subscription and petition are two different things. Subscription means you are a member of Kenya Association of Manufacturers or Kenya Chamber of Commerce and Industry, and you're paying annual membership or subscription to help the association probably operate or meet its expenses. Now that is very different from petition. What does petition mean? Petition means this company or this firm had disagreed or wanted to make certain representations. They wanted to be heard on certain issues, which probably they were not in agreement. So they got a lawyer to prepare some petitions, which they submitted to the company. Now, if, say, you have in mind what section 15 talks about, it only talks about subscriptions, not anything else. So that straight away tells you petition is not allowed because this one is not subscription. So what was allowed was subscription, annual subscription and membership fee. Next is notice of change of business name. Again, this is not anywhere, but there's something else that you can relate to this that will guide you in allowing or disallowing this. And there's something else which is there is something called preliminary expenses. So if you look at your section 15, you're going to see something called preliminary expenses, and there is a condition. It says preliminary expenses shall only be allowable if those expenses would have been allowed had the business been operating. And we give examples. A preliminary cost that is incurred before earning profit or before generating income for tax. An example is a farmer, okay? And you said a farmer can incur costs like fertilizer cost or cost of cultivation before he harvests. And you said it would be allowed because normally those costs would have been allowed even if the business was in operation. And you also give another example. Suppose a person wants to start a hotel business. And before starting operations, he has to recruit staff and do training, recruitment of staff. Again, it will be allowed. So that's as far as preliminary cost is concerned. It means cost incurred even before profit is gotten. So this notice is in that category. But then it is different. When Asema, they gave a legal notice, probably in the newspapers, that look, we want to change our name from the enterprise, J&K Enterprise, to Kaka Limited. But then this is not one of those expenses. I mean, our guidance, which you got, gave us an idea of what kind of expenses they incurred before, which would be allowed. Like look at fertilizer and expenses that directly relate to profit. Change of business name, which comes before, I believe it must have been change of the company's name, comes before the profit was earned, has no relationship to generation of profit. So this one is not allowed. Unlike the examples we talked about, so the condition was, make sure the expenses you are allowing is what you could have allowed had the business been in operation. That doesn't sound like notice of change of business name because there is no direct connection with profit, with generating profit. Then there is conveyance fees of business premises. I don't know whether you remember, but we had this same terminology in our first question, BD enterprises. I even remember the note. It was at note 4. Note 4 was explaining a breakdown, I think, of not general expenses, but a breakdown of was it not consultancy? It was a breakdown of 2 expenses, right? But it says included in that breakdown was conveyance of partnership of property, I think a figure like 24,400, and installing the bore drilling machinery at the farm, if you remember, 22,000. Yeah? So I'm trying to explain conveyance because I explained it in the other question. Anytime you see the term conveyance, it's legal terminology for services offered for buying or selling of property. So it refers to capital costs. Like in that question, they were very specific. They were saying for buying partnership profit, 24,400. Hapa was saying, okay, wanasema hata hapa, conveyance fees for business premises. They bought the building, conveyance. They bought the building. So again, it's not allowed. So I will not put anything until I come across what is allowed. You have to be patient and wait until you get something allowed. I know, coming for exam, you see everybody is writing and you're not writing. So you panic. There's a conveyance so that you can also start writing. Only start writing after you get the hang of what you're writing. Because even if you write and you're not earning marks for it, it doesn't help. So be patient. So any conveyance fees of business premises, not allowed. The next one is stamp duty. This one should be direct. Under section 16, the list we talked about, there was a very specific mention of taxes. Any taxes paid, and the examples were given, whether it's VAT, and that's why we were adjusting for VAT. Corporation tax, stamp duty, so this one should be straightforward, not allowed. Negotiating a business loan, again, that's a preliminary cost. You want a loan for the business, but the loan has not yet been disbursed. The process, before you receive the actual loan is preliminary. It cannot directly relate to generating of profit because the loan has not yet been invested in the business, so it's not allowed. Then we have recovery of bad debts. Now that's a business cost. So it means businesses could instruct their lawyers to write to their debtors, to write to their debtor, and you can get a very harsh letter. You're told notice, pay within 7 days, or certain things will happen. You're given notice to pay within 7 days. So this one is directly a business expense. So you bring it in. How much? 45. So we say recovery. It says recovery of bad debts. Recovery of bad debts. So 45, again as before, get 1/4 for the company. 1/4 of 45 will be 11.25. Now this is allowable deduction, and this one will be 33.75. So that's done. Then you continue. Signing a 100-year lease agreement. I'm sure most of you can answer this. We said lease agreements will only be allowable under section 15 if they are up to 99 years. That one is direct. It is there under section 15. A lease agreement must be up to 99. This one is 100 years, so it's not allowed. It's more by one. Purchase of partners' private residence. Again, this should be easy for you. Under section 16, it clearly states that any legal cost incurred in purchasing private property or personal property is not allowed. So again, that's not allowed. Appeal against tax arrears. Again, this should be direct. Under section 16, it talks about tax appeals to the tribunal or the courts are not allowed. So like I told you, some would be direct. Others you have to reason based on what you have. Take what you have under section 15 or 16, use that to guide you, So that's legal expenses we have done. So there's another expense after legal expenses is called repairs and maintenance. Repairs and maintenance has a note 5. So we go to note number 5. So note 5 says repairs and maintenance comprise purchase of furniture. Again, furniture is a capital expenditure. We said, let's leave all of them and charge investment allowances at the very end. So we are going to do that. Installation of neon sign, the same. It is capital expenditure. Let's do all of them at the very end. Designing of an office block also suggests capital cost. So if we had the cost of the office, this design will be added, the cost of the office, then we will claim investment allowances. Lakini designing alone on its own is not an asset. So you might not claim any allowance, but it's a capital cost. Partitioning, the same thing. We are going to claim capital allowance at the end or investment allowance. But repainting of business is allowed. Repainting of business premises, that suggests repair work. You're repairing, you're repainting. So bring in the 22.4, repainting of business premises, 22.4, so repainting. Of premises. So that 22.4 will get a quarter of that. So 22.4 will divide by 4 and we get 5.6. Then we multiply that by 3 and we get 16.8. That's done. Do we have any questions after that? Anyone with a question? Anyone? Remember, we are deducting only what is allowed. That's why we are not taking anything. That's why I'm even taking time to explain that this one we can't take it in, and the reason why we can't is this. Okay. So when you're in the exam, you reason with yourself. You reason from what you know, and then you decide what to bring in. what not to bring in. So that's note 5 we've done. We've done repairs and maintenance. Then we go to the next expense in the P&L. It's called rent and rates. Rent and rates is 244.6. Rent and rates does not have additional information. We know that this is business. This is direct business cost. So we just bring it here, rent and rates. Now, we'll divide that as we've done with the others. So 244.6 we divide by 4, and you get 61.15. And this one will be 183. That's done. That's rent and rates. Then there is interest on loan. Interest on loan has a note. You can turn to note 8. Note 8 talks about interest on loan, and this is what it says. Note number 8. Interest on loan includes interest on partners' capital of 100,000, which was shared according to the profit and loss sharing ratio. Again, remember, any payments to partners is personal, it's private, it's for maintenance of self. According to section 16, is not allowed. So this 100 will adjust it from the interest on loan. So the total interest on loan is 166. So we remove the 100. We are left with 66.2. So we get a quarter of that, and we get 16.55. So this is 16.55. Then you multiply that by 3, and you get 49.65. That's interest on loan. The next one is called general expenses. Now, general expenses also has additional information. The additional information on general expenses is note 6. It says general expenses included registering of patent rights, 64. Now, patents are assets, even though intangible. So that suggests that the 64 is a capital cost because it relates to an asset, even though it's intangible. Flotation costs, that must be for shares, is not allowed. What we said was allowable under section 15 was listing of shares for the first time. So the company is introducing itself, its shares in the stock exchange for the first time, then you can allow those legal expenses. This one is not. So this one talks about flotation costs, meaning any other company needing capital can still float shares to get additional money cheaply from the investing public. So that one is not allowed. It's only allowed the first time when you're listing shares. And we talked about that. If you go check again, you are section 15. The negotiating cost for additional piece of land. So land is an asset. So this is capital cost for business expansion, 56. So what are we saying? All the items listed in note 6 are not allowed. So we'll add them and subtract them from the total general expenses. So let me just add this first. So we have 64. We have flotation cost of 48. Then we have business expansion of 56. So the total is 168. Now this must be removed from general expenses. So general expenses given in our statement, so general expenses is given as 964. So come here and say general. And there's something I did not put here. Interest, eh? Then put interest on loan, I only talked about it. We have to put interest on loan points. Interest on loan. Now, interest on loan is 66.2. If I divide through, let me put general expenses before I forget. The general expenses, we have a total of 964. We subtract 168. What is this allowed? Now, let me put these figures now. Okay, let's put the figures. First of all, interest on loan was 66.2. I divide by 4. Put hiyo nilikuwa nimeweka. Mimi nilikuwa nasahau. 964 minus 168. The difference is 796. You divide that by 4 and you get 199. You send that number in the past. So once again, for that. So 199 times 3 is 597.
I have a question.
Done. You have a question?
Yes, about interest on loans. Interest on loans on my side, I'm having 166,200, and you talked of
There was 100. Uliangalia note 8. Kulikuwa na 100, which is interest on partners capital. That one is not allowed. So it's like tumechukua hiyo 166 tukatoa 100 ikabaki 66.2. Uliona note 8?
Yeah, nimeiona.
Yeah.
7, not 7.
Ni note 7. Sasa hiyo 100 unatoa. Sasa ukitoa 100 inabaki ngapi? 66.2. 100 is not allowed because it's paid to the partners. So that's personal, that's private. Any payment to the partners is not allowed. Sasa hiyo 66.2, hiyo ndio tume divide hapa. Unless I'm wrong. 66.
No, you are right. You are now right.
Yes.
I get the point.
That's what we divided by 4 and multiplied by 3. 66.2.
Okay, understood. Thank you.
Okay. So that's general expenses. Then we have motor vehicle expenses. So we bring in motor vehicle expenses. So motor vehicle expenses ni 840. Tutachukua quarter. I think itakuwa 210. If I'm not wrong, 210. Then you multiply by 3. Then you get 630. That's for motor vehicle expenses. Then you have insurance. Insurance is 156. So we get a quarter of 156. Ni 39. Then you multiply that by 3, you get 117. Then preliminary expenses are not allowable. Those are expenses incurred before the business started operation. So the expenses that are not directly connected to the business. They are not wholly and exclusively incurred for the business. So we leave that out. Directors' fees will charge only to the company. For the simple reason, the partnership has partners. So directors usually are for the company, limited company. So directors' fees will charge to the company. Audit fees so audit fees is 148.2. So this is 37.05. I know some of you might be wondering, let me just finish this. I know probably you might have a question like, isn't audit fees just for the company? The answer is legally, statutorily or according to the law, is only a company that is supposed to audit. But even sole proprietorships do audit. So we were not asked about what the law says. We are asked to think rationally if, say, the partnership would have audited, and they audit. Partnerships usually for purposes of transparency, and for other reasons, because an audit report would be useful for the business for many other reasons. So a partnership is also capable of doing an audit. So that cost is split like that. That's audit fees. Going forward, we have debenture interest. Again, you must know what debentures are. Debentures are loans a company would borrow by issuing bonds. Just like the government issues bonds to the public, a company can also issue bonds and you invest in those bonds to earn interest. Those bonds are called debentures. A partnership cannot, because a partnership cannot be listed at the stock exchange. So you'll bring in debenture interest and charge the whole amount to the company. So debenture interest, the whole amount we charge here. We charge to the limited company. Then you have traveling. Traveling expenses in 96 and a quarter would be 24. And this one would be 72. Like that. Then we'll get investment allowances. Remember we said we'll get investment allowances last. Sometimes, okay, once you make it a habit, you'll just remember that now I've come to the end of the other expenses, I need to bring in investment allowances. So the first asset is computers. I'm looking at the list up there, 180. So you come here and see computers. The rate for computers currently is 25%. So I'll get 180. I multiply by 25%. If I multiply 180 by 25%, I'll get 45. A quarter of 45 would be 11.25. And this one would be 33.75. So that's our first asset. Then going down under repairs and maintenance, which was a note, we'll have additional assets there. So repairs and maintenance is not 5. Purchase of furniture is 96. So we'll bring in furniture. The cost of furniture is 96. The rate is 10% for furniture. 10% gives us 9.6. A quarter of 9.6 is 2.4. 2.4 and 7.2. That is furniture. Then there is installation of neon sign. So neon sign is 60. So we get 10% of 60, and 10% is 6. A quarter of 6 is 1.5. And that one is 4.5. That's neon sign. Then office block, like we said, is not an asset. Unless the cost of the office was there, then we would add it to the cost of the office and deduct building allowances. So, here office tutaacha, but then we'll put partition. Now, the cost of partition is 250. So partition would be another 250. And we get 10%. So 10% of 250 is 25. Then a quarter of 25 be a quarter will be 6.25. This will be 6.25. We multiply by 3, we get 18.75. That's partitions. So those assets are done. Note 6 does not have an asset. If you look at the P&L, nafikiri tumemaliza assets. Ukienda chini, hakuna. So what happens is we will get the remaining as profit. For the partnership, it ends there. You know that, because after that, whatever we get as profit or loss, we prepare a distribution schedule. For the company, it doesn't end there because the company is a legal entity. We don't need to prepare a distribution schedule for a company. Any other income shall be added there. So we will get, for both, we'll get the adjustment, the profit or loss. So we can get this. So I'll get the total expenses for J and K, so 33.75. I'm adding the expenses plus 16.8 plus 183.45, 49.65. So the total expenses, I hope you're getting the same, is 1875. Total expenses for J and K is 1875. So I'll subtract from the income of 3955.5, and the difference is 2080. 2080.5 as the profit for the partnership. I hope you can confirm the same. I'll now get the expenses for the company, the limited company. So 11.25. So again, I don't know what you're getting. I'm getting 1585 as the total expenses for the company, 1585. So I will subtract 1585 from 1318. So it means I'll get a loss. This one will be a loss, 1318.5, and the loss is 266.5. This is negative. Yeah. So for the partnership, I have a profit of 2080.5. For the company, adjusted loss of 266.5. This one I'll call business profit. Business profit or loss. Business profit or loss. Now, business profit or loss, I will get any other sources that I need to include here. Just for the company, for the partnership, you include in the distribution. And the other source of income to include, if you can go back to the list of incomes under sales, you'll find there's dividends from Kali Cooperative Society. Even in that, in the first question, we still have dividend from farmers at the grassroots. Now that dividend is taxed twice, so it must be included for the second time. For the partnership, you're going to share it in the distribution schedule. For the company, we just add it here. So you'll say add, not add back, but add. This is extra income, so you say dividends from Kali. Dividends from Kali Co-op, it's 51, I'll get a quarter, just like we're doing for the beginning. So 51, I'll divide by 4, and I add here 12.75. Then I'll end up with a loss tail. So we say total business loss. The total business loss for the partnership is 253.75 million. 253.75 negative. Now for the company, you call it total business loss. Remember, we've not finished the first part. The first part of the question wanted taxable profit or loss. For the company, umemaliza. For the partnership, you don't get taxable profit until you've distributed. So we still have to distribute the 2080.5 before we can have the answer for part A, the taxable income. So now we move to the other side and prepare a distribution schedule just for the column here partnership. Sorry for that. So we look at distribution. Distribution review. So we want to distribute the 280.5. So bring in the partners. So we have partners, we have James, and they have a profit and loss sharing ratio at the beginning of the question. The profit and loss sharing ratio is the ratio of 3:2, so 3/5. And these are thousands of shillings. Then we have Katana. The profit and loss sharing ratio is 2/5. And we have the profit. Like that. Okay, so first of all, we'll start with the interest on capital. Remember, there's a note, is it note 7? Ilikuwa na interest on capital ya 100,000. Okay, ilikuwa note 7, yes. There's interest on capital of 100,000, note 7. So tutaanza na hiyo. Interest on capital. Interest on capital is 100. But in note 7, there's something they are telling us. Interest on loan includes interest on partners' capital of 100, which was shared according to profit and loss sharing ratio. So 100, 3/5 will be 60, and 2/5 will be 20. 40. 2/5 will be 20. Okay, then we can also bring in salaries. They add salaries. So partner salaries, najua ilikuwa 720, but we have to look for it. Ilikuwa note gani partner salaries? I think ilikuwa kwa the whole schedule hapa. So we go back to the statement. Yes, it's there. Partner salaries is 720. And we'll share in the same way. 720, so 720. So this one would be 288. And this one would be 432. So that is partners' salaries. Now, did they have interest on drawings? No. Did they have any other income? No. So the difference would be the profit share. So share of profit. So leave space as we hold it down. Then you bring what we had in that column. We are 2080.5. Then here, 2080.5. So 2080.5, see what happens. What remains 2080.5 minus, we deduct 820. And this is 1260. 1260.5. Five or four. This is 7. So having shared all incomes, now we add. We add downwards. And this one is 12. This one is 14. There. So we can try adding this, see whether we get 2080. Yeah, we get 2080.5. So at this point, we remember that there was other sources. We had dividends from farmers, which we can share here. So dividends from Kali. So dividends from Kali Co-op, the remaining amount, the whole amount was 51. 51 will multiply by 3 over 4. and we get 38.8.25. So here 38.25, they'll share according to the profit and loss sharing ratio. It will be 22.95. It will be 15.3. Then they became directors of the other company. So the directors' fees were theirs. So we also have directors' fees. Directors' fees will go roughly 600. So your 600 unagawa directors' fees to itakuwa 360, itakuwa 240. Out of this, you get the total taxable income. So it is 610. So this is now the point at which we have completed part A. We have taxable income for each of the partners. Remember, we said the partnership cannot be taxed. So this one will pay tax, unatumia graduated scale, EP unatumia graduated scale. The company will not pay tax because they have a loss. And actually, in part B, that is what they'll ask us. They'll ask us to explain the tax treatment of each of the partners and of the company. But before we go to part B, do we have any questions on part A? Because part A required that we get the taxable income. So this is the taxable income of James, Katana, and then the company has a loss. So those are the entities, the two individuals and the company. So do we have any questions for part A? Anyone? Any question? Okay, so if there's no question for part A, you want to answer the B part, they'll ask us about the tax treatment. Probably they'll not ask us to calculate tax, but they'll ask us about the tax treatment. They say B, comment on the tax position of James, Katana, and the company. So B, tax position. So tax position, we comment. So first of all, we'll have James. James and Katana. So we'll have James and Katana. So comment on James and Katana, then we can comment on the company. So the examiner did not want us to calculate. Alikuwa anataka comments peke yake, so we'll give our comments. So James and Katana, you say, the partners are taxable. The partners are taxable on their total income. The partners are taxable on their total income. The partners are taxable on their total income using the partners are taxable on their total income using the individual graduated scale. The partners are taxable on their total income using the individual graduated scale rates, using the individual graduated scale rates of tax, using the individual graduated scale rates of tax. Then we comment about tax treatment of Kaka Limited, the company. And you say the company shall not be liable. The company shall not be liable to corporation tax. The company shall not be liable to corporation tax. Since it has a loss, the company shall not be liable to corporation tax. Since it has a loss which is carried forward. Since it has a loss which is carried forward. Since it has a loss which is carried forward to be offset. Since it has a loss which is carried forward to be offset against profits. Oh, Lord. Hello. Oh. Yeah. The next minutes. Okay. O pale más. O pale katika kopa. Sawa. So Kaka Limited, sorry for that. The company shall not be liable to corporation tax. The company shall not be liable to corporation tax since it has a loss which is carried forward. Since it has a loss which is carried forward to be offset against profits from the same source. Since it has a loss which is carried forward to be offset against profits from the same source in the future. To be offset against profits from the same source in the future years. In the future years. So that comes under specified sources of income. You cannot mix the loss against other sources. You have to carry forward. You're allowed to offset against the same business which generated that loss. So B is done. Finally, part C says this. Part C says, citing examples, advise James and Katana on 2 areas of tax avoidance that they could explore for the business. So areas of tax avoidance means how can James and Katana reduce their tax liability without contravening the law? We had a similar theory in the previous question, part A. They were asking, explain the meaning of tax avoidance, and we refer to them to the Tax Procedures Act of 2015, and also gave a general explanation that it is a way of maybe it's the arrangement of the affairs of a taxpayer in such a way as to reduce their tax liability without contravening any tax law. You don't break any law. So the same concept is being asked here. How does James and Katana legally reduce their tax liability without breaking any law? That's tax avoidance. So some of the areas they've already used here, but they've not exhausted. One of them is there were a few assets from which we claimed investment allowances, like they had computers, the ones we did last, they had furniture, they had neon sign and partitions, only 4 things. Probably they can invest more in assets, they can claim more deductions in terms of investment allowances. Then another area they could use is they could take the loan they had is actually small. I think the loan was it 250? Yeah, Walcona loan, about only 250. That's another area. Interest on loan is liable, so it can reduce your taxable income. So we'll point out these 2 areas of legally reducing tax liability without breaking the law, without contravening the law. So please say areas of tax avoidance to be explored, areas of tax avoidance to be explored, areas of tax avoidance to be explored. The first bullet, use of debt. Use of debt as a source of capital. Use of debt as a source of capital for the business. Use of debt as a source of capital for the business. use of debt as a source of capital for the business, as the interest on debt, as the interest on debt is treated as allowable expense. As the interest on debt is treated as allowable expense for tax purposes. As the interest on debt is treated as allowable expense for tax purposes. Then another area, the second area, acquiring of capital assets for business use, acquiring of capital assets for business use, which will enable the company, acquiring of capital assets for business use, which will enable the company to claim investment allowances, on the capital expenditure incurred, as allowable expenses, against income, Okay, so that's how we treat conversion. I think I should give you another illustration, but this one for you as an assignment. I think there's a question in November 2017. Let me just confirm. There's a question in November 2017, I think, which will give us a different perspective, because the one in November 2017, you'll start from the reported profit. So unlike this one, which we started from the gross profit. So that will give you a slightly different approach. November 2017 equation. In November 2017, May 2017, this is question 3B. It's called Wema and Nenda. So you can try May 2017, question 3B. Question 3 part B. Question 3 part B inaitwa Wenda Enterprises. Wenda Enterprises. So Wenda Enterprises, ya Wema and Nenda, I think inakonvertiwa into a company called Dawadu Limited, and it's being converted in the month of October. And then this one, you're not starting from gross profit. You are starting it from the reported profit. Can I see the requirement? The requirement says, separate statements of adjusted taxable profit or loss. Separate statements does not mean separate as in different statements. You just have columns, the same way as we have this. So the requirement is separate statements of adjusted taxable profit or loss for Wenda Enterprises and Dawadu, the company, for the year ended 31st December. Hint is start with the net profit. The one for November 2015, the hint was start with the gross profit. This one is start with the net profit. I don't know hiyo yenu ni page gani, but yangu ni page 140, but it seems like our pages are different. Why do we consider directors for only after conversion? So these are questions from Brenda. Now, Lisa, why did we charge directors' fees, the 360? Why did we charge it only for the company and not for the partnership? Now, here's the logic. The partnership has partners. And I'm sure when you looked at the question, you saw partners' salaries. In a company, we have directors' fees because a company doesn't have partners. It has directors. What directors are paid is not salaries. It's called directors' fees or directors' allowances. That's why it's reasonable to take the whole amount, 360, and charge in the company because we don't have directors in a partnership. Strictly speaking, in a partnership, we have partners, not directors. Directors are in a limited company. That's why the whole payment, directors' fees, you charge in the company's column. Any other question? Any other? So I think the time left ni kidogo. We may not start this and finish, but you can try it. Yes, there's another question. Have you assumed January? Or you've understood, okay. There's another question here. Naulizo about January. Let's see. Lucy anasema, have you assumed January to be the time the partnership started because it has not been indicated? Were we not told the period? Let me go back there and see how this question is coming by. So mimi nilikuwa nimefunga yangu ilikuwa page gani? Naulizwa kama na assume walianza January. Probably is not an assumption, but let's see if we can get an answer from that question itself. I have to go back to the question to be able to answer you adequately. So this is 2015. It was November 2015. Okay. November 2015. Sasa, Lucy is asking a question. Anasema, kwa nini tuna assume ni January? Sasa wanasema hivi. Wanasema hivi, look at the second sentence at the beginning of the question. Inasema, the following is the income statement of the partnership for the year ended 31st December 2014. If the year is ending December, where does the year start? Doesn't it start in January? Wanasema the year is ended in December. So reasonably speaking, the year was 12 months. So it must be beginning in January. Kama it's ending in December, it's beginning in January. Does that make sense? Wanasema it's for the year ended, then the year must have begun in January, because every year is 12 months. Actually, under the Income Tax Act, it's the act that assesses income relating to only 12 months. It's only related, even if you're given a period of more than 12 months, you have to adjust the incomes to fit within a period of 12 months. You were the section again. So kama unaambiwa the year was ending in December and the tax year must be 12 months, then it must have begun in June. Okay? So you have this to try. May 2017 question 3B, Wenda Enterprises, and then remember the other one. Even December 2022. December 2022, here was question 3B. Lakini December 2022 was for the other subtopic. Ilikuwa retirement. Retirement of a partner. I think inaitwa A, B, and C. AB partnership. So AB partnership converts into ABC Limited. ABC partnership converts into ABC Limited. So you have these two questions. So with that, tumemaliza conversion. So partnership has only one more subtopic, and that is incomplete records for partnership. And That's what we should be starting. But before we start incomplete records, probably, I hope, we can be able to go through this. If you come out to Tamaliza 2 questions in 2 hours we are meeting on Saturday, 11 to 1, because we have to finish this, and then I introduce the new topic. The new topic is called incomplete records. So that one will complete partnership, then we go to limited companies. Any other question? Anyone with a question? Any other questions? Okay, thank you very much for coming. Please enjoy the rest of your evening. Tuonane Saturday, 11 to 1. Again, remember, if you need a recording, the lesson was recorded, please request from Mr. Kimani, and he did explain at the beginning of the class. You can send your email. So thank you very much.